And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
The Fed wimps out and markets rocket higher. Of course, also following Meta's earnings last night. Stocks are going to be up fairly sharply this morning. Of course, we'll be talking today with Michael Leibowitz discussing more about what the Fed said yesterday. But bottom line is they just pretty much gave up. They did hike rates by 25 basis points, of course, but the big shift was the acknowledgement of both disinflation, which he mentioned like 14 times in the speech yesterday, but also that, and really what sent the markets running, is that they don't really care about financial conditions in the short term. So total change in policy over the course of just the last 6 months, because financial conditions mattered back in September, back in December, as stocks were rallying higher in anticipation of a Fed pivot. And he would come out and basically smack the markets down. Yesterday, he's like, yeah, we don't really care about those financial conditions short term. It's fine. Go have fun with the markets. And with that, stocks rocketed higher yesterday, finishing the day up a little over 1%. We are now starting to push more kind of very overbought levels in the market. Doesn't mean the markets can't stay here for a little bit longer. They can. But our MACD buy signals that we track fairly closely here, those are starting to get pretty extended here as well. So, upside here is probably somewhat limited, maybe another 100, 150 points on the upside, somewhere to around 410, maybe 400 to 4150. On the S&P index is a likely target here, which will also be some of these kind of previous tops that we saw, back, last year on the way down. We're now seeing them on the way up, and those are going to provide some resistance levels. But overall, things are still very bullish here. Stocks are performing better. Last year, FANG stocks were dead. Now FANG stocks are back alive. So be careful with headlines when people tell you, it's like, oh, FANG stocks are never coming back. They're over. It's done. They've actually been performing fairly well. And again, Meta, after their announcements yesterday on earnings, revenue and earnings were good. Outlook was good. But basically, years of kind of cost savings, employee reductions, those type of things, tightening their belts, so to speak, has paid off and is looking a lot better on Outlook. Stock will be up about 20% this morning. On that news. So that's going to, and again, because of the market cap weighting of Meta in the index, that's going to kind of drag the entire index up. But you expect to see overall, you're going to see futures, not futures, but just see stocks kind of trading a little bit higher this morning. Now, the question will be, is whether or not they can hang on to those gains. NASDAQ will be about 1% this morning at the open. Can they hang on to those gains? Again, historically, about 80% of the time, the day after the Fed meeting, stocks tend to kind of sell off. So we'll see what happens. Maybe we open up this morning and then sell off. We'll don't know yet, but we'll see what happens. But again, the real focus here as of late has been technology. That's been performing very well. And really, it's been most of the junkiest stocks, right? I mean, if you take a look at stocks making the biggest moves, ARK, which is Cathie Wood's ETF that invests in a lot of the disruptive technologies. Of course, that got completely crushed last year. And that ETF has had its largest monthly gain on record. It's up 28% for the month of January. Now, a lot of these stocks, if you take a look, they're having huge runs. Some of these stocks are up 50, 80, 100% from the lows. They're still down 75% from their highs because these stocks were down 80, 90% from their highs. So, if you go from $100 to $1, that's a huge decline, 99%. But if you go from 1 to 2, it's 100% gain. You really haven't done much to nick that decline from $99 or $100 previously, but you can have very big gains off the bottoms. Right now, we're seeing a lot of these stocks that have gotten completely crushed last year. Peloton is a good example. Up 22% yesterday. alone. And some of these stocks are up 40, 50, 60, 70%, 80% in the month of January. You look at a long-term chart, it doesn't look like they've moved at all, but they've had very, very big gains here. And the point about this is that there's a lot of speculation coming back into the market. So again, early speculators coming in, kind of front-running the Fed here a bit. But again, as I'll talk about with Michael Leibowitz yesterday, the change in language has now really changed the market tone over the course of the next couple of months. Now, does this negate the other issues that are coming, right? This is going to be the big challenge for the markets. The Fed is still doing quantitative tightening, right? They're still reducing their balance sheet. They're still hiking rates. And in fact, they're going to hike rates a couple more times this year, according to their speech yesterday, which is still tightening monetary policy, right? That's still going to slow economic demand, right? But the bet right now by the markets as well as investors in general, and even economists and analysts all together, right now the only country expected to be in a recession in 2023 is the United Kingdom. So again, what the market is betting on is this soft landing Goldilocks scenario. We don't have a recession, we just have a slowdown. Unemployment rate ticks up here a bit and inflation comes down. That's the Goldilocks scenario, because in that environment, supposedly, things should be able to kind of hold together. Now, the one thing that we have to consider and remember is that part of what created the earnings run back in 2021, 2022 was the massive expansion in profit margins due to a big shutdown in the economy, which stripped a lot of employment out, which really increased the profitability of companies, and inflation, because that gave companies the ability to price things higher. And if you haven't been to the store lately to buy a dozen eggs, you'll know what we mean by price hikes. But a lot of that has fed into profit margins for companies. Now we're talking about, and again, as we'll talk about in a minute, but yesterday repeatedly, Jerome Powell mentioned the word disinflation. Now, disinflation and deflation are two different things. Disinflation is when you have declining inflation. So, in other words, you still have inflation, it's just going up at a slower pace. Deflation is when you have falling prices and falling inflation, right? That's when you have negative inflation. And so we're going to have disinflation first, but disinflation ultimately leads to deflation. And that's going to be a problem for profit margins, and particularly with profit margins near record levels, this is going to become problematic as we go forward. And again, as we start talking about valuations and earnings and pricing of markets, etc., it suggests that upside to markets over the next couple of years is somewhat limited. So in other words, we could have a bull market for certain, but we may not have a bull market that gets us back to historic highs or start cranking out as we saw from 2010 through 2020. Over that decade, we were generating 12% annualized rates of return. We may have a move to a market that generates positive returns over the next few years, but they could be somewhat muted, 4, 5, 6% rates of return versus 12. In other words, a return to normality after a decade or so of massive monetary interventions and zero interest rates. We'll see what happens. And the question is also, does the Fed actually cut rates sooner than later? This is all the bet that the market's making right now. And right now, again, as I said, market's having a very good run here, getting a little bit overbought. So don't forget to take some profits here. We will have some type of corrective action. And that's actually going to be really a good thing here as we start to talk about where this market pulls back to, where it finds support, and more importantly, where does it actually begin to form a much more bullish pattern of higher prices. And so those things we talk about here over the next couple of weeks. But coming up after the break, we'll talk with Michael Leibowitz more about what the Fed said yesterday, what the outlook is, what that means for the markets and money. Of course, get by our website and subscribe to our new YouTube channel for our Before the Bell. That's our previous 3 minutes on markets and money, now called Before the Bell. Separate channel, subscribe to that. Make sure you subscribe to this channel right here as well. Just click that little bell icon. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. It's 6:17 as we get this Thursday. Second best day of the week, by the way. I forgot to tell you that. And the big question. If you're having a sense of deja vu this morning, Brent? Just maybe a little bit. Does it feel familiar? You know?
Yes. We've been here before.
We've done this before. Yep, it's Groundhog Day. So we'll see if Puxahani Phil sees his. What time do they do that? That's a
daybreak Eastern time. So
Yeah.
probably right about now.
About now. So we'll see whether or not he sees his shadow and whether or not we have 6 more weeks of winter, which, considering we've got 400,000 Texans right now without power because the windmills froze up.
Oops.
Green energy is a great thing. I've got nothing against green energy. It just needs to work when you need it the most. That's my only complaint about it. You know, right? Solar power, wind power, it's all great, fine and dandy as long as everything's perfect, but who cares? Everything's fine. We got plenty of juice. It's when you don't have sunshine and when you freeze over. That's when you really need the power.
The cloudy, windless days of winter.
Exactly. That's really when you need power to work. I mean, you know, in the middle of summer, you can open some windows. It's okay. You kind of live without power when it's 10 degrees outside.
Frankly, I miss August.
Yeah, I know. It's coming. The only thing I don't miss about August is mosquitoes, but other than that.
Yeah, well.
Other than that. A couple of things this morning. Lots of earnings. Of course, we are now in really just the depths of earnings season. This week and next week, we'll have basically the entire S&P 500, for the most part, a big chunk of it will have reported earnings. Today, yesterday we had Meta after the bell. They reported much better than expected earnings. That stock's going to be up about 20% this morning at the open. Today we've got Apple. We also had Microsoft earlier in the week. Today we've got Apple, Alibaba Group, Google, Alphabet. I wish these people would just leave their names, right? It's Facebook. It's not Meta, right? It's Google. It's not Alphabet. But anyway.
And it's the Facebook.
It's the Facebook.
The Twitter.
Hey, you know they're actually trying to say the word "the" is now hateful. Right?
Grief.
We should not use the word "the."
Please.
You know, like the poor, right? That disenfranchises poor people because you're lumping them all together as the poor. I don't know what that means for the Walmart or the Target, but apparently Walmart's feeling very disenfranchised with the in front of it. Anyway, so Bristol Myers Squibb, Canadian Goose, that's, Brent's favorite. Cardinal Health, ConocoPhillips, Eli Lilly.
Hey now.
Ferrari announces today, along with Ford Motor, Gilead Sciences, GoPro. Are they still going and proing?
It's the GoPro.
It's the GoPro?
Yes.
I haven't even heard
The
about
GoPro.
it. GoPro had this flash in the pan. I haven't seen any videos lately with people running around with GoPro stuck on their head. I guess it's still a thing. My favorite, Hershey's, announces
I know what
today.
happened to those videos.
Yeah,
They all killed themselves off.
pretty much. Skechers, Starbucks, Under Armour, and of course, Michael Leibowitz' favorite, Worldwide Wrestling Entertainment. Yes,
WWE.
He's a big fan of WWE. So, speaking of WWE and SmackDowns, that was what happened yesterday with the markets, as the Federal Reserve came out and pretty much just wimped out. Came out, said, "Hey, yeah, we're hiking 25 basis points, and we don't care about financial conditions in the short term at all." So, with that, markets took off, and we had a very nice rally into the end of the day. Markets, futures, NASDAQ's right now pointing up 154 points at the open. It's about 1.5% on the back of Meta's earnings. So we're going to see some follow through, particularly in tech. And interestingly enough, in November, we wrote an article called "Are FANG Stocks Dead?" And we made the case for why FANG stocks weren't dead at the time. And those have actually been leading most of the market this year so far. So just be careful what when people tell you that something's dead, generally it's not. So, anyway, Mike, welcome to the show this morning. So big news from the Fed yesterday. They pretty much just rolled over, played dead, feet up in the air. And Jerome Powell just basically kicked the can back to Congress and says, yeah, it's Congress's job to raise the debt ceiling, not mine. So we're just going to keep doing what we're doing. With that, markets pretty much took off. So what now? The Fed pretty much seems to have given up.
Well, I wouldn't say given up, right? They raised rates 25. He said they're going to do a couple more 25s. So they'll get Fed funds up to 5%, which is where they projected it in December. They're kind of doing everything they said they would do. I think why the market's a little bulled up on it is that he wasn't as harsh on financial conditions. And the Fed likes to define financial conditions as stocks, bonds, and the dollar.
Oh, by the way, real quick, I have to interrupt because Puxahani Phil is about to make his prediction that is live on Fox News right now.
And I got some bad news for you.
He's going to see a shadow today?
Well, it's cloudy here about an hour or two south of wherever Puxatawny Phil is. So
okay. So no shadow today, which means no window. So wait, if he sees his shadow, I forget what it is.
If he sees his shadow, he goes back in the hole. You got 6 more weeks
of winter.
Right.
So no shadow today, so winter's over.
So good.
But there's so many TV lights on him right now, there's a shadow.
Probably. So anyway, sorry, they've got him up on the stand at the moment, and he's about to do his
Give the guy some decon.
Exactly. So
Who needs Jerome Powell when we got Phil?
Exactly. And this should be the new thing. If Puxahani Phil sees his shadow or not, right?
Yeah.
We'll have to go back and do a
6
check.
more points of inflation.
We'll see what it means for the markets, right?
Yeah,
We need to do a
yeah.
comparison, right? So
The
there we go.
groundhog index.
Exactly. So anyway, Mike, sorry to interrupt. With the Fed, yes, they said, hey, we don't care about financial conditions in the short term. And that's, really kind of what the market was afraid of, because back in September, he cared about financial conditions. In December, he cared about financial conditions. What's changed? Why doesn't he care about financial conditions now?
I think he's just slowly gaining confidence that inflation has peaked. Now, for those of us that have been looking at the data for the last 6-9 months, we've known that, right? We have enough data to know that inflation is coming down. We can debate all day what parts of inflation are coming down. Goods are coming down a lot quicker than what Powell calls core services, non-housing services. But nonetheless, you look at any graph of inflation or inflation surveys, inflation expectations, and they've all been declining. So I think he's finally having a little confidence that inflation is coming down. I think what bothers the Fed is that they call it wrong again. Remember, late 20 and 2021 was all about transitory inflation. That was related to the supply line problems and the extra demand due to stimulus. And it turns out transitory wasn't so transitory. It was a lot longer. So I think they're just being protective on the way down. The last thing they need is for inflation to stop falling, to either stall at relatively high levels, call it 4 to 5%, or to start rising again. So what they're telling the market is that, look, we're more flexible, we're more pragmatic, we're only going to raise 25 more, twice more, probably stop. That leaves them in May. They'll stop in early May. But this is the big difference between what the market thinks and what the Fed thinks is from May to December. The market is starting to price in at least 2 rate cuts, whereas the Fed is still pretty adamant that they're doing nothing, that they're going to keep rates the same. So that's the divergence we need to keep an eye on. Does the Fed acquiesce and start admitting that they're going to lower rates, assuming the economy can kind of, not collapse. If it collapses, they're going to drop rates much quicker. But assuming the economy hangs in there, assuming that inflation continues to come down, and assuming that the parts of inflation that the Fed really cares about, the core sticky prices, which haven't started coming down yet, they start coming down, then the Fed may acquiesce and they may say, yeah, we may cut rates once or twice, which would feed the market's view. And conversely, if inflation starts getting hung up, like we're seeing some goods prices starting to rise, copper, lumber, used car prices ticked up. Gasoline isn't falling anymore, it's stabilized. So some of those things that helped us peak initially are not going to help anymore. So will the market start saying, you know what, maybe Powell's right, and they're going to keep Fed funds around 5% for the rest of the year? So I think right now, for the next month or two, that's what the market's looking at. Who's right, the market or the Fed? And then kind of in the back of our minds, we have to think about, what if they're both wrong? What if this economy is really going into a recession, in the second quarter, third quarter? What if the lag effect really catches up with the market? And at that point, Fed funds are going to 2% to 1%, but eventually to 0. So I think distinguishing between those 3 outcomes, and as we traverse time, we're going to vary between Fed funds being stuck at 5, Fed funds dropping slightly, or Fed funds plummeting, and that will help determine kind of the market course as we progress.
Well, and I think, this is going to be, kind of interesting to watch, because the market is pretty convinced here that there is no recession, right, coming. And, take a look at what expectations are for earnings, profit margins, those type of things. This is all suggesting, and again, there's a long history of the market, kind of predicting, economic growth in the future, 6 to 9 months. Earnings tend to kind of trough before we see the bottom in economic activity. So, the question now is the market completely wrong this time, or does the market know something that everybody else is missing, right? In terms of, a lot of the bears that are talking about, we're gonna have this recession, it's another big down leg of the market coming. I mean, there's much more anecdotal evidence right now that the bottom of the market is in, and that the economic landing, or whatever it is, may not be nearly as bad as a lot of the bears are thinking. We'll talk about that when we come back from the break, and how to position your portfolio for whatever's going to happen here. We'll see. We'll talk about that right after the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
An energy rebate equating to $100 a month for individuals. Now, my daughter would love this. She was just complaining about filling up her car.
Was she complaining about that while she's standing in line waiting on a $6 cup of coffee?
No.
The Real Investment Show podcast.
The gym that she goes to,
Yeah.
it is literally, ladies and gentlemen, 300 yards down the street to the gym. She drives. So I'm letting her learn her lesson about being frugal.
At realinvestmentadvice.com.
Learn to use your feet, Flintstone.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, Candid Coffee, and Lunch and Learn replays, plus each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for the Real Investment Show, or just click on the show links at realinvestmentadvice.com. realinvestmentadvice.com.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
Financial infidelity is a relationship buzzkill. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust. Improve your money talk. Register today at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, speaking of inflation, food at elementary and secondary schools up 254% over the last year. Fuel oil, which Mike will know this because he lives up in the north, 65% increase. Eggs are the third highest increase. As we talked about yesterday, the new thing is to own your own chicken farm, right? And now buying chickens are getting expensive as well. Eggs are up 49%, followed by airline fares at 36%. Butter margin up 34%. Flour 24%. Public transportation up 23%. There's a joke in there. I'm just gonna leave it alone. Fats and oil up 21%. So if you're gaining weight, it's inflation. Blame it on that.
Waistline inflation.
Exactly. The only thing down in price over the last year, beef and veal down 5.2%, and smartphones down 23%.
It's because nobody's buying them right now.
Yeah, but you have they can't afford it, right?
Right.
It's kind of an interesting point, right? They're spending all their money to buy eggs, can't afford a new smartphone.
Yeah.
So they're down 23% in price. So just thought that was interesting. Apparel is only up 3.8%. So just thought that was interesting. Gasoline, as Mike was saying a second ago, gas has stopped going up. It's only up 10% over the last year.
What is the deal with that? It keeps going up and down and up and down.
It's whatever commodity prices do.
Yeah.
So if oil prices go up or down, gas is going to go up or down.
There you have it.
There's just kind of a thing in there.
I wish HEB would get it right.
Well, see, this is the interesting thing, right, though, is that, and this is what's feeding into corporate profit margins, is that, prices are relatively sticky. So just let's take a dozen eggs, for example, right? So just use some round numbers. So let's say that a dozen eggs was $4 last year, and now it's $5 or $6 this year. Okay, well, when inflation comes down and the price of eggs come down, right, or inflation comes down, the price of eggs will come down, but they're not going to go back to $4, right? It's just like gasoline. You're never going to see $1.78 gasoline ever again, right? That's just, or $70 or $1 gasoline, which I grew up with. You're never going to see $1 a gallon ever again because prices are relatively sticky. So even if inflation comes down, this was what Mike was talking about a second ago, is that if inflation comes down and hangs around 3-4%, that suggests that prices are still going up. But in reality for consumers, even if inflation goes back to 2%, which is where the Fed wants it, the prices of groceries and gas and clothes and travel, it's never going back to where those prices were, right? Because those prices are relatively sticky. And once, producers of goods or services get to a price and they go, okay, everybody kind of likes this price, we're okay here, that price will stick at a higher level. So, that's why core prices tend to be a lot more sticky than commodity prices, which tend to fly all over the place. Anyway, but talking about this, the issue now going forward is how to trade the market, right? So the market's telling you one thing, and as we said, before the break, there's a lot of we just wrote an article on this on our website, by the way. It's called "Bullish Formations Defy Recessionary Forecast." The markets are not predicting a recession. The markets are suggesting that the economy is going to continue to grow. Now, as Mike is about to tell you, there's plenty of evidence out there that suggests we're going to have a recession, and it could be a fairly deep one, right? But how do you navigate this? If the market's telling you one thing, do you defy the market and say, I'm not going to pay attention to the market because the market's wrong? Or are you going to, follow what the market's doing and let the market tell you what to do next? This is going to be the big challenge. But, as we talked about, you've got a very important bottoming process that's occurring in the market. The 50-day moving average will probably cross, if the markets are positive by the end of the day, the 50-day moving average will cross above the 200-day moving average. That's that golden cross that historically pretends to higher prices over time. Doesn't mean right away, right? Prices can come back. You can have little sell-offs in the markets, but what these things are telling you is that the bottom of the market in October was probably the bottom. And while it may be a stair step higher, prices are probably going to trend higher now over the course of this year. Now, of course, that can change, and that'll depend on economic outcomes and earnings and what happens, but we'll have to see. Mike, this is going to be the big challenge, though, for investors, is how to navigate, all the bad economic data versus what the market's telling you.
Right. And that's going to be our biggest challenge, is navigating what we think lies ahead in June and in October and December versus what the market's doing today. And there are times where you just have to listen to the market. And I think we're approaching one of those periods now where sentiment and technicals and, what we're seeing in the riskiest stocks and small cap stocks and, other sectors are telling us that the bull is back. Doesn't mean it's back for the rest of the year. Doesn't mean it's back for February, but it means it's back for now. And the technicals are strong enough that you have to play along with it to some degree, even if you think we're going into a deep recession in the second, third, fourth quarter of this year. For now, follow the market. And, if you want a good example of why, go back to March of 2020. When you get to later March, early April, the economy was shut down. There was nothing going on. Everyone was scared to go to the store without gloves on and masks and eye gear and it was something we had never seen before. That was the beginning of a great rally, despite all the economic problems that lay ahead of us at that point in time. So, you have to be careful. It's very important to have these macro views and to understand where you think things are going. And we could very much be right that the economy is in a recession at the end of the year and the market's a lot lower. But we have to navigate between now and then. And right now, the markets are increasingly telling us that the market wants to run higher. Bond yields want to come down. They're telling us that Goldilocks is approaching us. And we say Goldilocks because the bond market is not dropping rapidly in yield. Yields have come down nicely. If the bond market, for instance, thought that that we were going into a recession, yields would be coming down much quicker. Fed funds would be pricing in more than 225 basis point rate cuts in the second half of the year. And stocks would not be doing as well. Mm-hmm. So, and you can look at earnings expectations for companies. They're supposed to come down, but not into recession territory. So the markets are all telling you that Goldilocks is the preferred forecast, meaning that the economy slows, but not too bad, that inflation comes back down towards the Fed's target, the Fed slowly lowers rates, and they basically get the plane to land safely so it can take off again. And that's ideal for the stock market. Mm-hmm. That's what the stock market should want to see here. Anything more than a soft landing is growth that would probably induce inflation. So that's why we keep calling it kind of Goldilocks. You don't want too high growth and you don't want negative growth. You just kind of want it right in the middle where it's low growth. It's enough to keep inflation down and enough to pacify the Fed. It's all about pacifying the Fed at this point for the market. So I think you have to have your economic opinions. You have to have your market opinions on where you think things are going, but you also have to just listen to the market. And every day we're reminded, at least in the last few weeks, bad news is good news. Good news is good news. If you offer to do more buybacks, that's good news, even if you don't even have the money to do it. Meta just announced, $50 billion in buybacks? Yeah, they don't 40. Have cash or free cash flow to even do it. These are proposals. These are announcements, but they don't have to buy it back. So everything that ran that sounds familiar from back in late 2020 and 2021 is kind of coming back in vogue. And, it's important to listen and to follow, but maintain your own opinions. And, we're just going to, as we said, I think we started the year. What's the theme for the year? It's audible. Yeah. We're going to be audibling. Bull to bear.
Yeah, and it's interesting because, as we, came into January, it was kind of a sluggish start and finally kind of got things going, on the 5th day of January. And then the rest of the month was exceptionally strong, and February has started out strong as well. But again, there's still a lot of a year ahead of us and a lot of things that can happen. But the one thing, and we'll talk about this when we come back, is like, who in a low growth environment, let's assume the Goldilocks scenario. So it's not recessionary and it's not super strong growth, right? It's just enough to bring inflation down, but not get into a deep recession. What sectors are likely to perform best in that environment? We'll talk about that after the break, but the question right now, and particularly for the rest of this year, and as we look at corporations announcing earnings, this type of thing, again, we have to also go back and look at, yes, a lot of the playbook seems to be coming back from 2020, 2021. The difference, though, is that we don't have QE, we have QT. We don't have $5 trillion in stimulus checks in the market. We don't have an economy that was shut down. We're now back to full employment. Wages are up. Those are all going to have a different impact on earnings and balance sheets and income statements from companies over the course of this year that the market may not be paying attention to just yet. So we'll come back from the break, though. What sectors tend to perform better in a recession, not in a recessionary, but in a disinflationary, slow growth economic environment? Be right back. We'll talk about that, how to potentially position your portfolio, what not to buy, and things you may not want to own in that type of environment. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Is your partner cheating on you? Financial infidelity is a relationship buzzkill and a wealth destroyer. Just in time for Valentine's Day, our next Candid Coffee will address how to avoid financial infidelity. Saturday, February 11th with Richard Rosso and Danny Ratliff. Build trust, improve your money talk, and pillow talk. Register today at realinvestmentadvice.com. How to avoid financial infidelity. Candid Coffee with Ratliff and Rosso. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
It's amazing what you can find on the internet if you just dig around long enough.
What have you discovered?
Phil's track record.
Oh, really?
Yes. So
Somebody charted that.
Well, they didn't chart it, but they tracked it back a decade.
I'm trying to help you out
Right,
here.
I know. Exactly. Tracking back to 2013, how often has Puxatawny Phil been right in his predictions about 6 more weeks of weather? He has a 40% success rate.
Really?
Yeah. So I don't know. I didn't get to see on the news because we were doing the show. I don't know if he saw his shadow or not.
He did.
He did.
6 more weeks.
6 more weeks. So
He says.
there's a 40% chance he's right. Now, NOAA right now is forecasting that the Northeast, and Mike will like this, is got a 33% chance of warmer than typical temperatures from February through April. Most of the South, where we are, of course not today, as we emerge from the freeze, have at least a 40% chance of higher than typical temperatures from February through April.
I've got a red maple tree in my backyard that has already budded out
Yeah.
from that warm weather we had last week.
Plants are all screwed up
Yeah,
right now.
yeah.
So one month they're freezing to death, and now they're all
Yeah.
budding out again. So
Of course, the front yard looks like it got hit by a chill. It's all dead, you know.
But one thing I'm pretty sure of, that is not the original Puxatawny Phil.
I'm pretty sure.
Yeah, he looks too young.
Yes.
Yeah.
A little too dapper.
Exactly.
We got to get you one of those top hats, you and Michael,
Yeah, we should do that. Have just for today.
for next year.
Yeah, there you go. All right, let's talk about a Goldilocks economy. Now, again, as Mike, said before, that's an economy that's not too hot, it's not too cold, it's just right. Yields come down because you have disinflation. Inflation's returning back to kind of those sub 2%-ish levels on inflation. Economic growth trending around 2%. And again, those have to go together. You can't have 4% inflation and 2% economic growth. That's just, they function together. And yields are a function of economic growth and inflation. So yields should be around 2% versus 3.5%. But let's assume that environment where you have slower economic growth, which means you have slower demand, which brings down inflation. Yields fall because of that, but it's not recessionary. Now, in that environment, what sectors will tend to perform better than other sectors? In other words, do you want to be in commodities versus emerging markets versus international markets versus domestic stocks? And within those markets, what sectors tend to perform better in that type of environment? So, that's kind of the big challenge that as investors, we've got to kind of figure out to navigate this year. And so you've got to kind of make some bets on if you believe the story of the Goldilocks scenario as well. So and again, you have to pay attention to the data. And as Mike said earlier, what we say today may change next week because of changes in the environment or the markets or the economy or whatever. And that's why being audible and being flexible is going to be important. But just talking about this idea of a Goldilocks scenario, what areas tend to perform better? Mike, what are your thoughts?
So I think, first of all, as this rally kicks off, and again, it could end tomorrow, it could end in a month, what we're going to see is what we've been seeing, the beaten down stocks, the high risk stocks, the very high beta stocks will probably do the best. Small cap stocks have done well as investors kind of get all frothed up at the bull market. But assuming Goldilocks persists and persists for a while, that's a low growth environment. So in that type of environment, we have to start thinking about kind of more higher dividend, yieldy type, kind of fixed income stock surrogates, maybe preferred stocks, maybe MLPs. And then you also have to think about growth. Now, when I say growth, I don't necessarily mean Apple, Microsoft, Google growth. I mean growth. These are companies that are growing significantly. That doesn't really matter if we're in a very slow environment because they're stealing market share from something else. They're not competing for market share. They're taking it. So they can grow at 50, 100, 200% regardless of the economy that's growing at 1%. So I think it's going to be a weird year where if we are in Goldilocks and if Goldilocks persists, that you could, a portfolio with a combination of, like some very high growth, good companies, but very high growth, young companies that are not necessarily fully proven, combined with some value dividend orientation, probably skewed a little bit towards dividend over value, but something like that may prove to be the winning formula.
This is going to be kind of an interesting year too, because, when you start talking about, a lot of the dividend yielding stocks, a lot of those fall into the value category, but a lot of those stocks really aren't value stocks. And we've written articles you've written an article about it lately. We've discussed it before, touched on it many times. So part of the challenge this year is for that dividend side of the portfolio is finding stocks that really are kind of a value dividend story that, may perform better in a slower economic environment. And again, this is going to be one of the key factors. If you take a look at companies like, say, a Procter & Gamble, not really a value company. We own it because it's in the index. And this is going to be one of the challenges. Mike's right about growth stocks. Stocks that can grow earnings in a slow economic environment are going to do a lot better. But one thing we also have to factor in is that some of these smaller companies are going to do very well, but when passive investors buy growth versus value, it's also going to drive up prices of stocks like Apple and Microsoft and Meta and others, right. Google, because they're in the indexes. So part of the challenge of investing is getting the growth versus value story right. And the other side is going to be, picking the individual stocks within those sectors. Again, Apple and Microsoft may go up in value because it's a growth story. But to Mike's point, those stocks that are not in the top 10, stocks of the index are going to go up a whole lot more, right? So that's where the stock picking will come in. I think one of the other challenges, Mike, that there's a lot of people, back in November of 21, we were talking about the energy story and the buying energy stocks because they were so beaten up. We had negative oil prices, in 2021. And nobody wanted to own energy. Everybody hated energy. It was, ESG and blah, blah, blah. Of course, we wrote an article saying, this is the time to buy energy stocks and, they're going to be the best performer in the next year. In 2022, they just massively outperformed. Now everybody's onto that train. which benefited from inflation and that type of market that we were in. But in a slow growth economic environment, commodities are probably not going to perform as well because you need inflation to drive prices. And the prices of commodity stocks are tied to the underlying commodity. So we may see those stocks tend to underperform a bit in a slower growth, slower inflation environment, right?
Right. And that's the reason I like the high growth sector if we're in that environment, because it doesn't matter what the economy's doing.
Right.
So I think that the key is, to kind of summarize it, is to stay away from the economy. The economy is growing at 1%. Earnings are only going to grow at about 1 or 2 or 3%. So there's going to be little earnings growth in that type of scenario. So the question is, where can you get earnings growth? And if you can, and I think that's in the very higher growth sector, especially those that are really beating up, because then you could get some price gains, some pretty big snapbacks, like we saw with Meta.
Yeah. And
then the other place in a very low growth environment is just take those 4, 5, 6% dividend stocks that are priced well, not overpriced necessarily. And then, Lance, you made a great point. And this is what, as if our job wasn't tricky enough. The other thing we have to balance is this market skewing more towards passive investing or more towards active investing? And, that one's harder to ascertain. When investors are comfortable, they're going to be passive investors. It's easy to just kind of set it and forget it, to set your 401k at whatever 80% stocks, 20% bonds, 60-40, 50-50, whatever you prefer, just leave it. Mm-hmm. And when you do that every other week, you're contributing to the S&P 500, and Apple and Microsoft and Google are going to be the biggest beneficiaries of that. But if investors start saying, you know what, I'm going to start skewing towards value. I want more dividends. I want some of this more, for lack of a better word, esoteric stuff, not the headline type stocks. Then you have more of an active market, and that favors some of those lesser known stocks that have good dividends, that have value, that have very high growth, but they're not in the passive indices. Yeah. So that's, again, we're going to be audibling all year, and some of it is not necessarily bull or bear, but it's sectors, and it's active, passive, and stock factors like dividends and value and growth.
Well, and that's why, on simplevisor.com, where we publish a lot of our research, we've created whole new sectors that are just looking at relative performance and absolute performance of sectors versus the market. So you can see, in visual form, what is outperforming, what is underperforming relative to the market on both a relative and an absolute basis. And that kind of helps give you that idea of where to start allocating money as you start to see the change in behavior of the market, towards, one sector or another as things develop. And that'll be a very important key for the rest of this year, is to watch those rotational changes as the market begins to come to grips with whatever type of economy that we're going to have later this year. You can go to simplevisor.com, check that out. 30-day free trial there. All of our absolute relative analysis is there on the website, and that's the same stuff that we use every day to manage our portfolios as well. That's at the website, simplevisor.com. All right, be sure to get by the website and subscribe to our latest newsletter. Also, our new Before the Bell channel. We have 2 YouTube channels now, one for the show. Be sure and click that little bell icon to subscribe to this show. But also, if you want the 3 minutes before the markets that we talk about every morning, that's called Before the Bell now, has its own channel. Subscribe there as well on YouTube. Have a great day. We'll see you back here tomorrow for Financial Fitness Friday with Danny Ratliff. Richard Rosso, have a great weekend.